The following program was provided by an independent producer solely responsible for its content. The opinions expressed do not necessarily represent the views of this station, its staff, board of directors, or underwriters.
Saving and investing can be confusing and overwhelming. We're here to break through the noise, misinformation, and confusion with easy-to-understand concepts and tools that you can put into practice right away. Whether you're a novice investor or an old pro, join Jason as he explores different topics on investing and personal finance. From 401ks to better budgeting decisions, we'll cover it all. Our investment guidance will give you the comfort and security of knowing that you're on track to achieve your goals. It's time to rise above all of the distractions of daily life and take control of your financial future. Welcome to Financially Fit with your host, Jason Haviland.
Hello, and welcome to another episode of Financially Fit with Jason Haviland. I'm your host, Jason Haviland, and today we're going to tackle the topic of mortgages. How to get one, what are some of the pitfalls, what are the issues that you might run into when you're trying to take out a mortgage, sort of everything surrounding the mortgage process. And today we're very fortunate to be joined by Cody Young, mortgage consultant at Mortgage Financial. Thank you for joining us.
Thank you for having me.
All right, let's jump right in. So you can do a lot of things on the internet these days, right?
Absolutely.
What would be a reason somebody would work with a mortgage consultant like you? What are some of the things you can bring to the table versus what they can find by themselves on the internet?
Well, I tend to see a lot of consumers are looking for the ease of access and the instant information online. But you definitely are going to benefit from working with somebody more local to your area in the sense of every time you may call somebody online, it could be a different person every time in these giant call centers. Okay. When you work with somebody like me, you start to build a relationship. I start to learn about your family, about your goals, about what you're looking to establish by owning a home. And I can help tweak every single aspect of your finances and your goals to help you achieve that. Okay.
So do you have access to the same products that people on the internet have access to? Or is there, so you get to know them, a little more personalized service. Is there anything else that you offer along those lines?
Absolutely. We have all the same products. Our rates are very similar, if not better. And from what I've seen from experience of other consumers who have started with an online lender and come to me, I tend to find that our closing costs and our fees are considerably less.
So you might save some money.
Exactly.
That's good. We're financially fit here. We're trying to save money, so that's good. And then I also suspect that I've done a lot of different processes online, and sometimes you get stuck, and sometimes you have questions. You're probably there throughout the process to help them sort of get the mortgage all the way through.
Exactly. I'm always available, and that's something that I feel is very important when you're dealing with potentially one of the largest financial transactions of your life. If you're lying in bed or at home at 8 o'clock at night, 9 o'clock at night, and something clicks all of a sudden and you're horrified, and you got to know the answer. You can text, you can call somebody, you can email. I'm a regular person. Yeah. We're always there, and we're always there to help you and guide you through the process.
Okay. All right. So let's say we had real estate people on the show in the past, talking to us about the seller's market and sort of how that is all unfolding here in Nashua and the southern New Hampshire area. So let's say you've decided to buy a house. The advice that she gave was go get the mortgage first. Line up, or the mortgage approval first, right? Get lined up for the approval before you go buy the house. Do you share that view, and is that what you recommend if somebody's going to shop for the house? Go get lined up for the mortgage first? Or do you have some other nuanced advice along those lines?
To be perfectly honest, that is right on. That's exactly what you want to do first. You want to come and you want to sit down with your finances with a consultant like myself and sort of explore your different options. You want to see what your budget is, what your monthly payment is looking to be. You don't want to go start seeing houses and fall in love with this beautiful home that's going to be perfect for your family, has the best yard, has a pool, everything, and find it's out of your budget.
Right.
So to eliminate all of that, you should definitely find out where you're standing financially prior to looking at homes.
Okay. You're going to buy a home. Going to go talk to Cody, get the mortgage all lined up. Now, what if your credit isn't great, right? If you've had issues in the past, if maybe you've gotten behind on some of your payments, how big of a barrier is that going to be if somebody doesn't have good credit?
So credit plays a really huge role in obtaining a mortgage, and the number one most important thing to learn about credit is that you can never go so far that you can't come back. You can always fix your credit. If you're willing to and you're willing to put the time into it, it can absolutely be achieved. Credit does play a large portion in being approved for a mortgage, but that's why most mortgage lenders, including myself, offer credit repair services. So if you come in and you say, maybe I had a couple issues back then, I missed a couple payments, I had something that was deferred or went into default, I'm able to take a look at that, review your credit report, and help you bring your score back up to where it needs to be for those optimal approval terms.
All right, so talk a little specifics. Like when you say, there's a lot of different definitions for good credit, bad credit. When you say sort of bad credit in somebody in that sort of credit repair range, what's the credit score for people that probably need that service before getting a mortgage?
So the credit that really needs the most effort to be put into is probably sub 600s.
Okay.
So most programs, and I can't say exactly as everyone's situation may be different.
Yep.
Generally, you look for anywhere between a 640 and a 660. But the climb from, say, a 550 or a 580 to a 640 is absolutely achievable in a relatively short amount of time, definitely faster than you might think it was. But if we see in the 5 areas, there's a lower chance, and that's more of an opportunity to work with the customer, build a relationship, and start building your credit back up.
All right, so and then if you're in the mid 600s, so mid to upper 600s, you probably, again, every situation is unique,
Of course.
but you probably are in the range of likely being approved.
Absolutely, and credit does play a large part, but it's not the whole bread and butter of being approved for a mortgage.
All right, and now are there, does it help you to go and increase your credit even further, perhaps because you get a better interest rate?
Of course.
Okay, so you might get approved at that 640 to 700-ish range, but if you're even higher, you'll get a better interest rate?
Absolutely.
All right, so that does make sense to do if, even if you've sort of crossed the threshold, improving your credit, it's always a good idea.
It depends for everybody. So if you're looking to maybe get into a first-time starter home, and you're tired of paying rent and you want to get in there, and you're in the 640, 680 range, it might be smart to get in now. Take the time to use a mortgage payment as a credit building opportunity. Maybe take a look at your finances and dial back where you have to, and then sometime down the line when your credit's up in the higher 750s, maybe it's time for that refinance. Or when you buy the new home, you have an even better interest
Or
rate.
upgrade,
Exactly.
Also you might want to upgrade the house from where you are. Okay. All right, so you're in the market, you're shopping, you got the house, you got the credit situation. There's a lot of people, though, that are solopreneurs. They're working in the gig economy, right? They're working for themselves. A lot of people, are working less and less for the big corporate entities and trying to sort of carve out their own way in the world. So they don't necessarily have a steady stream of W-2 wages. What's the prognosis? What does it look like if you're in that situation and you're trying to get a mortgage? Is it still possible? And sort of what are some of the things you'll look for in that kind of a situation?
Well, it's absolutely still possible, and you can ask almost any mortgage lender who their favorite style of person to work with is, and 9 times out of 10, you will probably find out a self-employed borrower.
Okay.
Doing a standard, W-2, 20% down vanilla mortgage it's easy. It's the bread and butter of our business. But when you have a borrower who maybe is a self-employed borrower, they do a Schedule K, a Schedule C, a corporation, an LLC, it gets interesting at that point. To work with all the different numbers you have, to take a look at the deductions and the losses and the profit and how their pay style works together, and really dialing in and finding the income for those kind of borrowers. It's absolutely possible. It takes a little bit more work, but that's the fun part of our industry.
Okay. And is there any tips that you can give those workers around what forms to schedule, or how do they sort of get their situation in order? Is it just making sure you have all those old tax forms, or do they need to prepare little mini profit and loss statements? What do they do to sort of get ready if they are a gig economy or solopreneur kind of person?
Exactly it's very largely based off of your tax returns and how much money you claimed as a profit or you claimed as a loss. I would definitely recommend sitting down with your accountant probably 30 to 60 days prior to applying and ensuring that all of your information is correct and everything is in order.
Okay. All right. So now we've covered shopping for the house, you're getting the mortgage, you got some different kinds, maybe your credit's good, maybe it's not so good. Now let's talk about the actual mortgage itself. You're taking out a loan to purchase a house. I've heard, and I see the term jumbo mortgage used. And so let's talk a little bit about exactly what that is. What's a jumbo mortgage compared to a traditional mortgage, and how do the two work with each other?
So a traditional mortgage is exactly what it is. It's traditional. It's generally more popular in areas and it's more common to see.
Okay.
So a conventional mortgage has a larger amount of investors. You generally are closer to the prime interest rate depending on which company you decide to go with.
Okay.
And the guidelines are generally specific. Once you start moving into the jumbo range, say if you were looking in,
So what is there a dollar? Is that just a jumbo is whatever it is to the company you're working with, or is there a real specific dollar number that designates or signifies a jumbo mortgage?
there is, yes. So it's different for every area, and it depends based on the borrower, based on where you're looking to buy, and which city or state you're in.
Okay.
But generally,
So
it's
what
separate
is it
for-
in this area generally?
So for a one family, I believe it just changed about 2 months ago. So you have to forgive me on this.
That's okay.
But
Ranges are
prior
good.
to
Just to help.
2017, it's about $424,000.
Okay, so if you're
for a single
above,
family.
if you're above that,
If you're
it's
in that, you're going to
considered-
start looking into the super conforming range.
Okay.
And as you continue to climb and climb and climb, once you hit about the 525 range, you'll start stretching into jumbo territory.
Okay.
And then once you have a jumbo loan, based on whether you have a single family or a multifamily, you're going to start seeing maybe a different interest rate, different MI prices, which is mortgage insurance,
Yep.
and different guidelines that you may have to follow because you're obviously lending a larger sum of money.
Right. And are those guidelines that you follow for your company? Do you have to follow different guidelines based on the kind of mortgage that you're dealing with, or sort of who you're going to potentially sell the mortgage to? Or do you have no, this is, when you work with Mortgage Financial, this is these are the guidelines, these are parameters we work under?
So generally we follow most of the larger investors' guidelines, and there may be a few scenarios where there are loan level pricing adjustments, which are
Yep.
different for each company. But generally you're going to follow the larger guidelines of the jumbo investors based
Okay.
on the loan amount, the area, the percentage of your down payment, your income, your credit score. So there's a lot of different factors that come into it.
Okay. All right. So that's the loan part. Might be a traditional, might be a jumbo. That's the amount that you've taken out to pay for the house. All right. What are points?
So points are fees that can be paid at closing to potentially lower your interest rate farther than what we are able to offer.
Okay.
So points were a lot bigger in the, prior to the 2007, 2009 recession, which was a larger issue as to why we started to see a drop in the market during that time.
Okay.
So they're not as popular now. It's definitely still available, and it might be a smart decision, but you tend to see it more with home investors, people who own several properties, and they're almost never seen with first-time home buyers.
Okay. So let's quickly sort of clarify this. So you might go in and say, all right, if the interest rate is 4.25% for no points, but then if you pay a point, which is 1%,
Yes.
then the rate comes down to 3.75 or something like that.
It's about an eighth to a quarter. It all
So-
depends.
all right, so maybe
it's something
for-
I see very, very rarely.
Okay.
But definitely, so you pay a percentage of the rate, and it may bring it down an eighth of a point, a quarter of a point, half of a point. But generally, you're going to see that over time, it's going to take a lot longer to really get that investment
Pay
back.
it back, right? So that's what you're
Exactly.
trading off, right? A lower,
Exactly.
you pay more up front and you get lower ongoing payment,
Of course.
right? And if you pay it off, depending on how long you stay in the house and how your mortgage unfolds, will determine whether or not that was a good decision for you.
Yeah, of course. So if for like I said, investors who are expecting to own the home for a full 30 years or however long the term is, it might be financially smarter if rates are a little bit higher, or if they're very low
Yeah.
and you want to get the lowest rate possible. And at the end of the day, you're going to save the money over the 30 years. But if you're going to live in your home for 5 years, 6 years, looking to start a family soon, maybe relocate, it's not a very wise choice. But
Okay.
of course, it's up to the consumer.
Okay, so that's the mortgage. It's potentially paying points. That might be a cost associated with the mortgage. All right, now this big blanket term called closing costs. Like, just explain. I think we sort of get it's like all that stuff that has to happen to get the mortgage done. But like, what are some of the costs that are actually in there, and is that something you can not pay as part of the closing process?
So there's very few opportunities where you're going to get into a home by paying nothing. Technically,
Okay.
I kind of work with the term, it takes money to make money. So there's always a cost with borrowing money. So closing costs are generally built up of what we call closing costs and prepaid items.
Yeah.
So closing costs are generally going to include your origination fee, the title insurance
All right,
fee.
so let's start. What's an origination fee? That
So it's the-
sounds like we're getting into like the car dealer term, right? All these fees listed on things. What's an origination fee?
The origination fee is what pays our underwriters, our processors, our pretty much the operations aspect of our company. So
Okay,
that's how
all
they get
all
paid.
the people that look at the actual
Exactly.
application and say, okay, this is this is good, this is not good. those people get paid through the origination fee.
Yes.
Okay, what other fees are in that closing cost bundle?
So your closing costs will also include your lender's title insurance, which is as well as your owner's title insurance, which is an optional fee.
Yep.
So those are both to ensure that the title of the property is clean, that there was no
Okay.
issues in the past, there were no foreclosures, there were no, say, construction liens or property tax liens left on the property.
So the person selling it is actually legally free and clear to sell it.
Exactly.
Which
When
is
you're
generally
buying
the
it-
case, but perhaps not sometimes.
Yeah, you just want to make sure there's nothing. You don't want to buy it and then find out, oh, there's a $200,000 lien on it because someone never paid their taxes for 10 years.
Right. Okay.
So we try to avoid that.
What else is in that number? The appraisal in that number?
The appraisal is in there, yeah.
All right, we'll
The
talk about
appraisal
that
is
in a
part of
little
that
bit.
as well.
Appraisal in there. What any other sort of big costs in that? I know I've seen it on mine. Like, and I try to go through it and say, all right, there's $50 for this, $70. It seems like a spot where stuff just gets stuffed. Is that,
There's definitely an explanation and answer for everything.
Okay.
So if you're escrowing your taxes and your insurance, which is when you pay into an account monthly and will pay your bills when they come on time,
right?
you'll generally have to put in a 2-month backstock of your taxes as well as your insurance. So that's going to be part of your closing costs
Yep.
/ prepaids as well. The start of your homeowner's insurance is going to fall into your prepaids as well because we expect the first premium to be paid, the first year to be paid right at closing,
Yep.
as well as your monthly payment.
Okay.
So it depends for each loan here and there, but it's sort of something where if you want to ask the question, don't be afraid to. If you
right.
see anything you're confused about, please bring it up.
Okay. Now, so agreed that some of those costs, like the insurance and the escrow, like you just the transfer stamp tax,
Yes, for New Hampshire.
things like that for New Hampshire, you just sort of can't get around. But there were programs, again, some of this more historically, where there was no points, no closing costs kinds of mortgages. Are those still available, or have those sort of gone away?
It's not something I personally do, and I'll be quite honest, I'm not too familiar with the process.
Okay.
They are still available, and it's one of those things where it's for your more savvy investor, somebody who might be a little bit longer, a little bit more well-versed in the mortgage process.
Yep.
If they have a few properties that they're trying to bring the interest rate down on, they want to refinance, as rates took a huge historical drop, they want to take advantage of that, but they don't want to pay any money out of pocket to refinance.
Okay.
So it's sort of based for that.
All right. All right, so now let's jump in a little bit on the appraisal, right? So we had our real estate broker here last week. She sort of let us know, scorching hot market here in southern New Hampshire, Boston area as well. Why is the appraisal such an important part of the process? And like as markets start to heat up, why does that, doesn't that appraisal sort of become less and less meaningful because people just keep bidding up properties or overbidding, right? You start hearing about people paying more than asking. So tell us a little bit about your thoughts on the appraisal process, and sort of what's going on there.
So the appraisal is hugely important because when you obtain a mortgage, you're technically using your home as collateral. So we'll use $300,000 for an example. If you buy a property for $300,000 and you put 10% down, so your loan amount's $270,000. If you take out a mortgage on a home that's not worth $270,000 and you decide just to stop paying your mortgage, you just
Yep.
forget about it, you want to go off the grid, the bank eventually has to make their money back. And
Right.
if they go to sell the property and they only get, say, $200,000 for it, they're in the hole for $70,000.
Right.
So it's not a smart investment on our end.
Right.
So we look to see that your loan amount
That's
is
part
gonna
of the
be-
reason for a down payment, right? That's one way to say,
Exactly.
all right, look, so if it's close, right, they can fire sale it, because they don't want to be sitting on it and go through all that. They just want to get out of it, so they'll sell it quickly at an auction or something like that. But they'll have your down payment, and so they won't lose money. But that's the bank. Your point is the bank, being able to get their money back is a large driver of how much they will lend you vis-a-vis the appraisal.
Exactly. So we tend to see the down payment is a financial investment from the consumer.
Yep.
So it's more based on, you've already put in this much money. You're going to lose that if you decide to stop paying your mortgage and default on it. We look at it almost as you're invested in this, you're not going to want to throw away your investment, which is why we require the down payment.
Yep.
And we very rarely will see 100% financing except for specific programs like VA and USDA will do it as well.
Yep.
But the appraisal is so important because we need to know the actual valuation of the house in the event that something goes wrong.
What could you really sell? If you're the bank and you got to sell it, what can you realistically sell it for?
Exactly.
All right. You mentioned down payments. That's another interesting point, because a lot of times people, all right, I got my mortgage, I'm ready to go, I'm going to buy my house, and they realize, oh man, I got to put 5, 10, 15, 20% down on this house. Like, what's the situation these days around the down payment?
So you're talking a lot about how appraisals are increasing high, going up as well.
Yep.
Home prices are increasing. So we're looking at down payment options now that are as low as 3.5%.
Okay.
So obviously, if you think back to the early 2000s, you think down payments, it was 20% down.
Yep.
My parents bought a house with 20%. Everyone needs 20% down. If you think about these massive home prices now and trying to have a 20% down payment, it's not feasible for a lot of consumers now.
Right.
So down payments have a lot of options from 20%, 10%, 15, 5, 3.5 to 0% down payments for, like I said, VA and USDA funding.
All right, and as the percent of the down payment goes down, I suspect the interest rate probably goes up.
There is a correlation to it, but the biggest issue with having a lower down payment is going to be a PMI charge, which is called private mortgage insurance. So if you are less than 20% invested into your property, the bank wants to make sure that wants to have an insurance policy on it. So you'll pay monthly into an account called a PMI. So that's to protect the bank in the event that if you only put in 3.5% and you do end up defaulting on your mortgage, there's a little bit of a safety net to make sure that we're able to sell out the house.
The bank has a...
The bank, yes, not we, I'm sorry.
Right. All right. So speaking of affordability and low down payments, another technique that was used a lot in the last decade was interest-only loans. Are those still available, and are there any situations where you'd recommend somebody take on an interest-only loan?
Interest-only loans are available. I personally have never seen one. I've never done one myself. But they're tricky in the sense that it almost puts a hold on your mortgage. So say you have a 30-year amortization.
Right.
Your mortgage will be paid off in 30 years, and you have some financial troubles or there's another specific reason you'd like to go interest-only. You only pay the interest on your mortgage payment.
Right.
You would not pay down the principal at all.
That's right. So you take off a $250,000 mortgage. You're just paying interest. You owe $250,000 forever, right? Like,
exactly.
As long as you have the loan, you just keep paying the interest, and you still owe $250,000.
The issue is, though, as you start to pay interest only longer and longer, you may get into the realms of negative amortization,
right?
Which means that your insurance and your interest and principal payment is not going to be enough to cover your mortgage by the time the 30 years expires, or 15, or however long you decide.
However long, right? So if it's I've seen it used in short-term situations where somebody's in some sort of transitional, they sort of know for sure they're going to move somewhere else, and they just want the lowest possible payment for this short period of time. That'd be a good example for it. Reasonable. Okay. All right. So what's your view, and maybe even I know you might not speak for your company or you're not the industry spokesperson here, but when we talk about sort of overheated sellers markets, people buying for houses above the asking price and putting in, ever increasing bids, do you feel like your industry, your company, has any obligation to sort of put the brakes on sort of overheated markets, and sort of what's your view when somebody walks in and says, hey, I want to put in an offer of $300,000 on this house, and is it really just I got to make the numbers work, or do you sort of take a bigger step back and have a little bit of a bigger picture and say, okay, like, no, this, these people are really putting in bids that are really too high for the value? Let the market, let the buyers and sellers work out an agreement, and we're here to facilitate?
It's similar to the latter of what you said, where it's at the end of the day, it's up to the consumer. Mm-hmm. I can always run the numbers, and I can always show you what we will approve you for, but at the end of the day, I'm going to ask you, do you feel like this is the right choice? Is this a payment you can work with monthly? Do you really feel your home is worth this much? And at the end of the day, it all comes back to the appraisal. If somebody's putting in 3.5% on a property worth $250,000 and they put an offer for $280,000, they need to come up with a difference.
Right.
So we definitely like to encourage our borrowers to make the offer, explore all of their options. But at the end of the day, they have to make the smart financial choice.
Right. And that, to you, like I said, you sort of lay it out for them and sort of give them the pros and cons, and ultimately they've got to make the decision: is this a good financial? Is this in my financial interest to make this purchase? Absolutely,
and there'll even be times where I'll recommend them to a financial advisor or somebody who that's their forte, is taking care of your finances and seeing what the smartest decision for you is. And at the end of the day, we like to help people achieve the dream of home ownership. I'm not willing to put you into a mortgage that's going to negatively affect you and that's going to hurt you and maybe turn you away from the dream of owning a home. Okay. So what else? So besides making a good, a solid financial decision that, it's a mortgage they can afford, it's a house they like, an area they like, right? It's in addition to sort of making those kinds of decisions, is there anything else about the mortgage application process, the application itself, the things they should do leading up to visiting you? You mentioned earlier sort of getting all your tax returns in order, making sure all that, is lined up. Anything else about
the application process or getting a mortgage that people are either surprised about or should really know about ahead of time?
The number one biggest piece of advice I give to everyone who is interested in the mortgage application process and buying a home is to do not be afraid to ask questions.
Okay.
There are so many different terms coming around. There are so many different aspects of the mortgage process that might be foreign to you, and I see a lot of consumers are scared to ask questions because they don't want to look silly or that they don't know.
Right.
And it's the most important thing you can do. Mm-hmm. You don't want to be locked into a situation and find out, I had no idea this was that, or this was this. And it's our job as mortgage
this
lenders.
Extra payment, like I've got all these other payments on top of what I thought it was. I did this calculation and the number's different than the number I thought.
Exactly. The process itself is very easy, and it's my job to be a professional and be very knowledgeable about the entire process.
Yeah.
But if you are not confident to come up to me and request the information, I'm not sure what you do or do not know.
Right. Okay.
It's the most, the
So
biggest.
ask questions. Get them answered.
Exactly. Please ask the questions.
All right. And I'm sure there's a formula that you use that determines how much of somebody's income is appropriate to be spending on the mortgage. So be interested in your opinion or what's the guideline for getting the mortgage approved? Like a lot of times what you'll get approved for on the mortgage might be higher than what somebody might recommend. So
Exactly.
let's talk to us a little bit about those ranges for how much of somebody's income should be earmarked or you should be targeting when you're thinking about how much to spend for a mortgage.
So generally the guidelines we like to see for, say, a standard conventional 30-year fixed mortgage, we like to see between 40 and 45% of your income.
Okay.
Obviously,
So that as a financial advisor, that sounds high to me.
It is
right?
a little high, but it is one of
yeah.
your biggest assets.
Right.
If at the end of the day, if you look at a mortgage, the expenses that you're paying are your insurance, your taxes, and the interest. The principal is pretty much a built-in savings account into the home that you're going to live in anyways.
Right.
So,
Building equity in the house.
Exactly.
You can sell it over time. Yep. Okay.
So there are programs that go up higher. It depends on your credit score and your income, so I can't quote anything.
Yep.
And there are programs that expect a little bit lower. But it's a personal question. We don't look at your car insurance payment, how much you spend on groceries, how much you spend on childcare. And at that point, you really
do
need to
or you
ask.
don't?
We don't.
Really?
We look at things that are
So you
reported
just
on
look
your
at
credit.
it in aggregate. You say, look, all right, this is how much they're making in aggregate. 40 to 45% is the range.
We look at different debts that are on a credit report. So if you have your obligations, so maybe, I can't think of the word now, maybe a debt that's like has a collateral, does not have a collateral, revolving credit cards,
Yep.
if you have a car loan, if you have student loans, if you have another mortgage,
Yep.
we're going to look at those types of things that you're obligated to pay. Less variable payments, so like childcare, gas, how much your car payment is. There's a lot of different things that we're not going to look at,
Yep.
depending on how they're reported back to us. But you have to think of it, how's it going to affect my life? Is it something,
Right.
the bank says I can do 40% of my income, but is that realistic for me to complete right now in my life?
Right, and that's a big aspect of this, right? Everyone's got to sort of go through that process, and I think that's a great reason to work with somebody. Have the questions, have the conversations, understand what it means to you, and hopefully at the end of the day, get your mortgage.
Absolutely.
All right, well, thank you, Cody. This has been a great session. I hope everyone's enjoyed our whirlwind tour of all things mortgage and mortgage related. Thank you for joining us on Financially Fit today. I'm Jason Haviland. We'll see you next time. Take care.
Saving and investing can be confusing and overwhelming. We're here to break through the noise, misinformation, and confusion with easy-to-understand concepts and tools that you can put into practice right away. Whether you're a novice investor or an old pro, join Jason as he explores different topics on investing and personal finance. From 401ks to better budgeting decisions, we'll cover it all. Our investment guidance will give you the comfort and security of knowing that you're on track to achieve your goals. It's time to rise above all of the distractions of daily life and take control of your financial future. Welcome to Financially Fit with your host, Jason Haviland.
The preceding program was provided by an independent producer solely responsible for its content. The opinions expressed do not necessarily represent the views of this station, its staff, board of directors, or underwriters.